Imagine it's a different decade, different clothes, different technology, different headlines, but the same feeling. That feeling doesn't announce itself loudly. It arrives quietly. A subtle shift. Something that used to feel solid now feels conditional. The numbers still exist, the institutions still stand, the systems still operate. And yet, trust feels thinner than it did yesterday. Every financial crisis looks different, but they feel the same because they are built on the same structure. This isn't about panic. It isn't about prediction. It's about pattern. To understand why crises feel identical across time, you have to strip away the stories told after the fact. Narratives are written to make collapse feel logical, to give chaos a cause, to turn uncertainty into explanation. What matters is not the story. What matters is the machinery underneath. Let's start with the illusion of novelty. Every crisis is framed as unprecedented. In the late 1920s, it was reckless stock speculation. In the 1970s, it was inflation and oil shocks. In the early 2000s, it was technology optimism. In 2008, it was mortgages and derivatives. In 2020, it was a virus. In 2023, it was interest rates. Different triggers, same collapse dynamics. The trigger changes because the system evolves. The feeling stays the same because human behavior doesn't. Financial systems are not mechanical systems. They are belief systems. They function because people collectively accept that claims made today will be honored tomorrow. Money is a claim. A deposit is a claim. A bond is a claim. Modern finance is a dense web of promises layered on promises, layered on promises. As long as belief holds, the system appears stable. When belief weakens, stability becomes conditional. When belief breaks, the system reveals its fragility. This is why crises feel personal even when they are systemic. Because belief collapses internally before structures collapse externally. The moment people stop asking how much will I make and start asking can I access it, the system has already shifted states. That shift is universal. Now consider leverage. Modern economies are built on borrowed time. Banks borrow short and lend long. Corporations refinance debt continuously. Governments roll obligations indefinitely. Asset prices assume liquidity will always exist. This works not because it's safe, but because behavior is predictable. Most participants don't demand settlement at the same time. Withdrawals are staggered. Payments are spread. Confidence smooths timing differences. Leverage exploits that predictability. But leverage creates asymmetry. Gains accumulate slowly. Losses arrive suddenly. A leveraged system doesn't fail gradually. It fails when timing compresses. When too many people want certainty at once. This is not a flaw unique to modern finance. It's structural. In the early 20th century, banks operated on the same principle. Deposits were payable on demand. Loans were long-term. As long as confidence held, it worked. When confidence broke during the Great Depression, thousands of banks collapsed not because the loans instantly became worthless, but because access was demanded faster than assets could be liquidated. People remember the Depression as a market crash. The deeper damage came from frozen access. The same structure reappeared decades later in different form. In 2008, it wasn't depositors lining up at local banks. It was institutions refusing to roll short-term funding. Repo markets ceased. Interbank lending stopped. When Lehman Brothers failed, it wasn't just one firm collapsing. It was confidence in counterparty settlement evaporating. Markets froze not because assets vanished, but because no one trusted the plumbing. That sensation prices without confidence is the core of every crisis. A falling price is not a crisis. A failing institution is not a crisis. A crisis occurs when participants no longer believe obligations will clear reliably. That belief doesn't degrade smoothly, it snaps, which is why policy responses always feel late. Authorities react to lost confidence, not to rising risk. Liquidity facilities, guarantees, emergency lending all are attempts to replace private trust with public assurance. Sometimes it works. Sometimes it only slows the process. But notice something important. Intervention changes outcomes, not experiences. For individuals, crises still feel the same. Accounts freeze. Credit evaporates. Employers panic. Plans collapse. The narrative might involve housing or technology or rates. But lived reality compresses into uncertainty and loss of control. This reaction isn't learned. It's biological. Financial crises convert abstract risks into survival signals. Access to resources becomes uncertain. The brain responds the same way it always has. Reduce exposure, seek safety, preserve optionality. This is why people use physical language to describe crises. The floor fell out. Everything froze. The system cracked. These aren't metaphors chosen carefully. They're instinctive descriptions of disorientation. Now look at how crises are explained afterward. Every collapse produces villains, speculators, bankers, regulators, algorithms. The villain changes, but the function of the story stays the same. Reassurance. If collapse was caused by bad actors, it can be prevented by removing them. If it was caused by a specific instrument, banning that instrument solves the problem. History doesn't support this. Each reform fixes the last visible failure mode while leaving the underlying structure intact. Leverage remains. Timing mismatch remains. Confidence remains the load-bearing wall. Because it has to. A financial system without confidence cannot function. A system without leverage cannot grow. The trade-off is unavoidable. This is where timing becomes critical. Crises don't begin when they are recognized. They incubate during calm. Risk accumulates when volatility is low. Buffers shrink when losses are absent. Efficiency replaces redundancy. Stability breeds fragility. This isn't rhetoric, it's mechanics. The longer a system operates without stress, the more aggressively it optimizes. Capital is deployed more efficiently. Liquidity is minimized. Safety margins are reduced because they appear unnecessary. Then conditions change. Interest rates rise. Demand shifts. A shock arrives. Suddenly assets that were safe become risky not because they changed, but because the environment did. This dynamic reappeared when Silicon Valley Bank collapsed. The trigger was interest rates. The structure was duration mismatch. The outcome was immediate loss of confidence. 48 hours was enough. The speed is new. The feeling is not. Digital systems accelerate runs. Screens amplify fear. Information moves faster than verification. But human response is unchanged. When uncertainty spikes, behavior converges. Everyone wants liquidity. Everyone wants safety. Everyone wants control. Individually, these choices are rational. Collectively, they are destructive. This is the paradox at the heart of crises. Rational behavior produces irrational outcomes. Economists call it coordination failure. Psychologists call it panic. Both describe the same collapse of shared expectation. And this is why crises feel sudden even when they were predictable. The build-up is gradual. The release is non-linear. Pressure accumulates quietly. Failure arrives loudly. Afterward, attention focuses on the trigger. The last headline, the final decision, but triggers are not causes. They are catalysts. A match doesn't cause a fire unless the forest is dry. Financial systems dry out during prolonged calm. Confidence hardens into assumption. Risk becomes invisible. Warnings feel abstract. Until calm breaks at that moment, perception flips. Before a crisis, confidence without caution. After a crisis, caution without confidence. Both extremes feel intense. Both are unstable. This is why recoveries feel incomplete. Markets rebound faster than trust. Balance sheets heal faster than expectations. Even when numbers improve, behavior lags. People remain defensive. Institutions hesitate. Growth slows. Memory fades only gradually. Those who experience collapse carry its imprint. They save more, borrow less, distrust leverage. Over time, those people leave decision-making roles. New participants enter without lived memory. The system stretches again. This generational cycle is why crises recur, not because lessons aren't learned, but because lessons decay. And that brings us back to the core question. Why does every financial crisis look different but feel the same? Because the feeling isn't produced by the trigger. It's produced by the realization of conditionality. The realization that access was never guaranteed. That stability depended on collective belief. That systems function until they don't. This realization is destabilizing because it removes permanence. Financial systems are presented as infrastructure, solid, engineered, reliable. In reality, they are closer to ecosystems. Adaptive, interconnected, sensitive to shock. They survive. They evolve. They do not eliminate risk. Crises are not anomalies. They are stress events in a system that trades certainty for growth. The cost of leverage is fragility. The cost of efficiency is vulnerability. The cost of progress is instability. These are design choices, not moral failures. And when those choices are pushed too far, the same sensation returns, the same tightening, the same disbelief, the same search for certainty. Because once a crisis begins, the system doesn't simply fall apart, it reorganizes. This is the phase people rarely understand in real time. The headlines suggest chaos followed by rescue. Markets plunge. Authorities step in. Stability returns. It sounds like repair. It sounds like healing. In reality, it's reallocation. Losses don't vanish, they move. When asset prices collapse, wealth isn't destroyed, evenly it's repriced. When institutions fail, obligations aren't erased, they're reassigned. Someone absorbs the shock. Someone always does. The only variables are who, how fast, and how quietly. This is why the feeling of crisis doesn't end when markets stop falling. The panic phase is loud and short. The redistribution phase is silent and long. It unfolds through policy decisions, accounting rules, liquidity channels, and legal hierarchies most people never see, but live with for years. And this is where trust erodes, because interventions are never neutral. When central banks inject liquidity, they don't send it everywhere at once. It flows through existing pipes. Large institutions, primary dealers, sovereign debt markets. Those closest to liquidity sources recover first. Those farther away wait. This isn't corruption. It's mechanics. Liquidity moves through scale. Systems are built to stabilize nodes whose failure would cascade. Individuals don't qualify as nodes. Households don't transmit systemic risk, institutions do. So the system saves what threatens the system. From the inside, this feels like favoritism. From the outside, it's architecture. Both interpretations are emotionally valid. This divergence is why crises leave scars even after recovery. Asset prices rebound long before wages do. Balance sheets heal faster than lives. The numbers improve while experience lags. People don't just lose money in crises, they lose time. Years of delayed plans, postponed security, missed momentum. That loss isn't charted anywhere, but it's remembered. This memory shapes behavior long after the crisis is over. That's why trust doesn't snap back the way markets do. Now look at how the system responds afterward. After every collapse, new safeguards are installed. Capital buffers, stress tests, resolution frameworks. Each reform is rational. Each addresses a real weakness exposed by the last crisis, but risk doesn't disappear. It migrates. Constrain banks and risk flows to non-banks. Regulate balance sheets and leverage moves off balance sheet. Increase transparency in one area and opacity grows in another. This isn't defiance. It's adaptation. Financial systems evolve around constraints the same way water flows around obstacles. This is why stability is always temporary. Not because regulators are incompetent, but because incentives remain unchanged. Return is rewarded. Resilience is tolerated, not celebrated. Risks that don't show up immediately are discounted. Until timing exposes them, and timing is everything. Crises rarely erupt because something is weak. They erupt because weakness meets stress at the wrong moment. A system can carry flaws for years. What it can't survive is synchronized demand for certainty. When uncertainty spikes, everyone wants the same thing at once: liquidity, safety, control. That convergence is fatal to systems designed around diversification of behavior. Individually rational actions become collectively destructive. People withdraw, institutions hoard, credit freezes, prices gap. And the system, which relies on continuous motion, seizes. This is why crises feel sudden even when they were years in the making. The build-up is gradual. The release is not linear. Pressure accumulates silently. Failure arrives loudly. Afterward, attention fixates on the trigger, the final spark, the last decision, the breaking headline. But triggers are not causes. They're catalysts. A match doesn't cause a fire unless the environment is dry. Financial systems dry out during periods of calm. Buffers thin, redundancies are removed, efficiency replaces slack, confidence hardens into assumption. Then a shock arrives, any shock, and it reveals what was already there. This is why hindsight feels cruel. The signs were visible but not persuasive. Warnings felt abstract. Felt real. Human cognition favors recent experience. If the system has worked, it assumes it will keep working. If volatility has been low, stability feels permanent. Until it isn't. At that point, psychology flips. Before a crisis, confidence without caution. After a crisis, caution without confidence. Both extremes are unstable. Both distort decision-making. Both feel emotionally intense. This is why recoveries feel incomplete. Even as indicators improve, behavior lags. Institutions remain defensive. Individuals stay cautious. Growth slows. Risk-taking hesitates. The system stabilizes, but trust recovers slowly. Then memory fades. This fading is not accidental. It's generational. Those who live through collapse carry its lessons. They save more, borrow less, distrust leverage. Over time, those people age out of influence. New participants enter with outlived memory. The system stretches again. Each generation learns the same lesson differently, and the lesson is always the same. Stability is conditional. There is no permanent configuration that eliminates crisis, only temporary balances between growth and fragility. Now layer modern complexity on top of this. Today's financial system is faster, larger, and more interconnected than ever. Capital moves instantly. Information travels without friction. Feedback loops are tight. Contagion is immediate. Efficiency has increased, so has sensitivity. Speed reduces reaction time. Complexity obscures causality. Interconnection amplifies shocks. This doesn't mean collapse is inevitable. It means the margin for error is thinner. When things go wrong, they go wrong faster. And yet, the emotional experience remains unchanged. People still feel blindsided, still question assurances, still scramble for liquidity, still look for explanations after the fact. Different interfaces, same instincts. This continuity explains why crises feel personal even when they're systemic. A farmer losing savings, a homeowner losing equity, a worker losing employment, a founder losing access to capital. The mechanisms differ. The rupture feels the same, because the rupture is psychological before it is financial. It's the moment of expectations collapse. Expectations of access, of fairness, of continuity, of tomorrow resembling today. Once those expectations break, numbers lose meaning. What matters is exposure, and exposure is deeply human. This is why crises are remembered emotionally, not statistically. People don't recall exact figures. They recall waiting, uncertainty, silence, the sense of being outside, decisions that shaped their lives. That feeling is the constant. So why does the system persist if it repeatedly produces this outcome? Because the alternative is stagnation. A system without leverage would not grow. A system without risk would not innovate. A system without confidence would freeze. The trade-off is unavoidable. Modern economies choose episodic crisis over permanent immobility. That choice is embedded in policy design, whether acknowledged or not. When authorities intervene, they aim to preserve continuity, not eliminate volatility. They smooth extremes. They contain collapse. They accept moral hazard as the price of survival. This trade-off shapes behavior. Participants learn that catastrophic outcomes will be managed, not prevented, but limited. This knowledge encourages risk-taking, which increases fragility, which demands intervention. The loop closes. This is why the system feels both resilient and brittle. It survives shocks, but at the cost of reinforcing conditions for future shocks. From within, this feels contradictory. From above, it's consistent. Now return to the original question. Why does every financial crisis look different but feel the same? Because appearances change, but structure doesn't. Triggers evolve. Instruments mutate. Language updates. But the foundation, confidence, leverage, timing, trust remains intact. And when that foundation is stressed, human responses converge. Fear, flight, search for safety, demand for accountability. These responses don't care about asset class or regulation. They react to perceived threat. That's why explanation doesn't eliminate the feeling. Models don't calm nerves. Equations don't restore access. Understanding comes after impact, but understanding still matters, not to avoid crises, to orient within them. Orientation doesn't remove pain, it removes confusion. It replaces shock with recognition. When you recognize the pattern, the feeling remains, but it's not mysterious. You understand that what's happening isn't unique, personal, or unprecedented. It's systemic. That understanding doesn't protect assets, it protects perception. And perception shapes experience. Because in every crisis, there are two collapses. The financial collapse, and the narrative collapse. Those who lose the narrative, who can't explain what's happening, suffer most intensely. Those who understand the structure still face consequences, but they aren't disoriented. They know stability was never absolute. Access was conditional. Growth always came with fragility. This knowledge isn't comforting, but it is grounding. And grounding is the only constant available in a system designed around uncertainty. Different decades, different instruments, same structure. Same human response, same feeling, not because the system failed to learn, but because the system is doing exactly what it was designed to do.